In this video, we are going to talk about dividend stocks to buy for passive income. So before starting this video, please like this video, and subscribe to our channel for the future updates. As the environment has changed dramatically in the last half-century, the financial sector has changed dramatically as well. Naturally, we attempted to adapt to, if not overcome, change on a continuous basis. These developments had an effect on our everyday lives, habits, and behavior, including our investment decisions. The question of, was life easier in the old days, has been the subject of numerous surveys and studies. Needless to say, both sides might have legitimate points in this debate, and I am not going to go into it here. But one thing is certain: many things have vanished entirely, while others have grown or changed shape. As a result of this change, a slew of novelties emerged as byproducts. There are no exceptions to this rule when it comes to investment rituals and decision-making. Many complex instruments and commodities have been added to the markets in the last 2 decades. From basic algebra to rocket science and engineering, financial expertise shifted. There are thousands of firms to invest in, as well as hundreds of instruments. For low risk and consistent returns in the past, investing in savings accounts or long-term bonds was possibly the best option. And it was the right investment approach to let your investments develop passively through compound interest. Short-term interest rates are currently near zero, and risk-free assets are no longer risk-free. If inflation rises in the future, long-term government bonds will suffer significant, absolute losses. As a result, income investors must employ an aggressive investment policy to control their funds. We assume that dividend stocks with a long history of increasing dividends year after year are the best option for passive income investors. Here's a list of the dividend stocks to buy for passive income. Let's start. Number 5. Cisco Corp. Cisco is a world leader in food commodity sales, promotion, and delivery to restaurants, healthcare and educational institutions, lodging establishments, and other consumers who prepare meals away from home. As predicted, the company's sales and revenues plummeted as a result of COVID-19. The COVID-19 pandemic is more widespread and longer in length than previous disasters affecting our business, and it is likely that real uncollectible sums may vary, and additional charges will be required, according to the financial statements. I anticipate a rebound once this issue is resolved. It's time to reinvest in recovery stocks like Cisco now that 3 separate vaccine candidates have shown at least 70% efficacy. The company's dividend yield is 2.57%, and it increased its dividend from 39 cents to 45 cents last year. While the company might not be able to maintain its dividend growth rate next year, analysts are positive about 2022. There were 33 hedge funds investing in this stock at the end of September, according to the number of hedge funds. Number 4. General Dynamics. A business from the aerospace and defense industry is ranked 4th. Despite the fact that COVID-19 had a negative impact on the market, the company was able to mitigate the damage. Phoebe N. Novakovic, the company's chairman and CEO, said, "We continue to reduce debt and invest in the company for potential growth." GD is a buy for Oakmark funds. General Dynamics is one of the largest defense contractors in the United States, and it owns the world's most prestigious business jet franchise, Gulfstream. We were able to buy this high-quality business at a significant discount to both its historical and peer valuation levels due to short-term concerns that the coronavirus would affect demand for business jets. In the long run, we expect the company would profit from new product introductions in its business jet segment, improved free cash flow conversion, and a visible decade-long rise in deliveries of next-generation nuclear-powered submarines. We assume the discount to intrinsic value will close as these positives become more apparent. GD stock is currently trading at $148.36, with a trailing P/E ratio of 13.5. This is also the lowest figure on our chart. The latest quarterly dividend is $1.10, which translates to an approximately 3% annualized dividend yield. The dividend payout was increased by 7.8% compared to the previous year. At the end of September, there were 37 hedge funds with long positions in the stock. Number 3. Chevron Corp. Chevron is a leading integrated energy company in the world. Explore for, generate, and transport crude oil and natural gas, refine, market, and distribute transportation fuels and lubricants, manufacture and sell petrochemicals and additives, and create and deploy innovations that improve business value, according to the company's key operations. Despite the fact that lockdowns and slumping demand due to COVID-19 had a significant impact on the company's revenues, 43 major hedge funds took bullish positions in the stock. The best time to buy oil stocks was 3 weeks ago, before the vaccine news was out. We aren't, however, too late. Chevron stock has risen by around 40%, but there is still demand for another 20% rise in the next 12 months. While you wait, you'll get $1.29 in quarterly dividend checks, which equals a 6% annualized dividend yield. Chevron has increased its dividends for 33 years in a row. When we look at the top 3 funds with solid positions at Chevron, Fisher Asset Management comes in first. Ken Fisher, a billionaire and one of the most well-known money managers in the financial world, held a $390 million stake in CVX. Diamond Hill Capital and Kahn Brothers both have significant positions in the stock. Number 2. Exxonmobil Corp. ExxonMobil, like Chevron, is a company that deals in oil, gas, and consumable fuels. Exxon has grown from a regional kerosene marketer in the United States to one of the world's largest publicly traded oil firms in its 135-year history. At the end of September, there were 52 hedge funds with bullish positions in XOM. First Eagle Investment Management holds the largest share in the stock, worth nearly $1 billion. Here's what they had to say about the stock. ExxonMobil's stock continued to struggle in the third quarter, losing nearly half of its market capitalization year to date. Despite this, we thought ExxonMobil was well positioned to deal with lower prices and would continue to be a compelling investment. Despite the challenging business climate, the organization exhibited high levels of operational flexibility and continued to grow its earnings capacity. Its high-quality, long-duration assets hold favorable cost curve positions. Indeed, earlier this year, the massive fall in XOM shares culminated in a double-digit dividend yield. Over the past 37 years, ExxonMobil has effectively raised its dividend. In annualized terms, the current dividend for the third quarter of this year is 87 cents per share, resulting in a dividend yield of 9.42%. This is the highest yield available from the companies listed in this article. First Eagle is right. Over the next 12 months, Exxon shares have a significant upside potential. Number 1. PepsiCo Inc. Pepsi-Cola and Frito-Lay combined in 1965 to distribute their goods as a single entity. Consumers in more than 200 countries and territories around the world appreciate their brands. Did you know that Kentucky Fried Chicken, Taco Bell, and Pizza Hut were spun off from PepsiCo in 1997? PepsiCo reported nearly $48 billion in sales, $5.28 billion in net income, and $3.79 net income per share in the first 9 months of 2020. Additionally, our industry continues to be affected by disruption of the retail landscape, including rapid growth in sales through e-commerce websites and mobile commerce applications, including through subscription services, the integration of physical and digital operations among retailers, and the international expansion of our industry, according to the most recent financials. As a result of the COVID-19 pandemic, we've seen and expect to see a continued transition to e-commerce, web to offline, and other online shopping by consumers. This explains why, despite the tough circumstances, we have good sales and cash flow. The share price was $143.42 on November 20, 2020. There were 52 large hedge funds invested in this stock at the end of the third quarter. Donald Yachtman's Yachtman Asset Management is ranked first among these asset managers. Pepsi is also a favorite of AQR Capital Management and other quant hedge funds. The company's current dividend is $1.02, which equates to a 2.85% dividend yield on an annualized basis. The dividend distribution was raised by 7.07%, from $0.9550 to $1.0225 over the previous year. PepsiCo Inc. has raised its dividends for 48 years in a row. What do you think of our video? Let me know in the comment section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.